let's talk deregulation at the Federal Reserve with the great Michelle Bowman, Federal Reserve Vice Chair for Supervision. Michelle, welcome back.
Well, thank you. It's great to be here.
Nice to see you.
Nice to see you too.
You don't have any motorboats aimed at the oil tankers, do you?
I don't. I have a pontoon boat on a very small lake in Council Grove.
Okay. I shouldn't call it. You like modernization. You're in an important spot.
We do. We call it modernization because what we're trying to do is position the U.S. banking system to support the U.S. economy through businesses and consumer loans, and in ways that we push them out of activities out of the banking system outside of the regulatory perimeter. So our focus is ensuring that banks can get back into those activities that will allow them to support the U.S. economy.
How about, it'd be nice if banks made loans.
That's an important
C&I, commercial,
function.
Industrial loan. When I was a youngster and working at the New York Fed and then on Wall Street, we used to track C&I loans. Very important.
Very important.
Okay, so let's start there. How will you modernize it so we'll get, I'd like to get them out of the reserve business and into the lending business. How can we do that?
Well, absolutely. And one of the things I talked about last week, and as you know well, Larry, is that what we want banks to do is to be able to get back into the mortgage business in particular, because more competition leads to lower prices for mortgage loans. It leads to better accessibility for consumers and more housing affordability and more home ownership. So that's one area that we're working on. We're taking a look at making sure that our regulations are fit for purpose for each size and risk that banks present. So we have banks as small as $5 million in assets and banks as big as $5 trillion in assets. So we want to make sure that our regulation and supervision is appropriate.
They're different.
They're very
different.
That's right. Very, very different.
Good. I'm glad I got that. So Kevin Warsh, who will likely be the new Fed chair, okay, you know him well, I know him well. He'd like to shrink the Fed's balance sheet. He'd like the Fed to have fewer assets. Now, my question to you is, can you figure out a way to help that along? Can banks own more treasuries? Not the Fed. I don't want the Fed owns too many treasury bonds. I'd like the Fed to get out of that business. I'd like the commercial banks to own more treasuries. They're very safe. And fewer reserves. Why do they have to hold all these reserves? So, and actually, the interest rate on reserves is really the Fed funds rate nowadays. It is 3.6%. I follow this somewhat closely, and I talk to people who are much smarter than I am. But here's the point. Can you get the Fed to shrink its treasury holdings and instead get that over so the commercial banks can own them?
So there are a couple of ways that we're thinking about that. One in particular is through our liquidity requirements for our banks, and to define in a better way how we talk about high quality liquid assets, or HQLA. So there are a number of ways that we're thinking about that, and I agree with you. I would like to see a smaller balance sheet as well, and I think we can accomplish that through some different approaches or improved approaches to liquidity requirements.
I think the Treasury Department should be in charge of treasuries. And if banks, if they want to own, it's a risk-free asset. But the whole thing, if QE distorted all that going back a ways. So the other thing is the supplemental leverage ratio, which let me just try to simplify. Are banks overcapitalized? How about that? Are they overcapitalized? And can you cut back on that so they again have more resources to make loans to medium and small businesses?
Yep. Following the financial crisis in the aughts, we really improve the capital positions for all of the banks across the size range in the system. So absolutely, they're very well capitalized. And one of the ways that we're looking at reframing the financial, the bank regulation is to ensure that our capital requirements are fit for purpose, that they actually describe risk and that we're judging each of the risk holdings appropriately. So again, it's lowering the risk weightings for mortgages. I would say that there's room to improve that position, or to lower that,
right.
Yes.
I think a lot of people agree. I think Jamie Dimon agrees with you.
Well, what we'd like to see is more lending in business and for consumers. So one way we can do that is to ensure that the capital is available for them to lend.
So speaking of lending, we didn't have a fabulous jobs report today. Non-farm payrolls down 92,000. Last month was very strong. This month was not. It's a winter month. I don't know. The purchasing managers had much stronger jobs, but it wasn't fabulous. The unemployment rate ticked up to 4.4%. What does Mickey Bowman want to do about that one?
Well, I'll tell you, I've been watching the labor market closely since mid last year and recognizing that there's been some fragility. And that's why I pushed for 75 basis points worth of cuts before the end of last year. When we wrote our SEPs, our Summary of Economic Projections for 2026, based on the labor market conditions and my expectations there, I wrote in 3 additional cuts for 2026. I think I was fine with holding at our January meeting, but now that we've seen that the labor market, maybe that was an anomaly with that data we saw that was relatively healthy in January, it's nearly completely retraced in February, and that really indicates to me that there is a trend that is the labor market deteriorating, which allows me to continue the path that I believe is appropriate for 75 basis cuts for the end of this year.
Should the Fed cut rates? There's the meeting in March, right?
There is a meeting in March.
Should the Fed cut rates here?
Well, we go into our blackout period tonight at midnight, and I'll look forward to the conversations that I hear from my colleagues and discussions that we have in preparation for the meeting. But I think we'll get an inflation reading next week, and that will help us make a determination about what we think.
This thing today, whatever it's worth, could be a game changer, though.
I think, in my mind, it is.
In terms of perceptions and expectations.
It confirms to me that that the labor market continues to be weak, and it could use some support from our policy rate.
You know, I had my friend Chris Waller, just sitting right where you are. You know him well, Federal Reserve Governor, terribly smart guy. And we were talking about these Federal Reserve estimates. What do you call them?
Our Summary of Economic Projections,
right,
our SEP.
SEPs. So I asked him, how come the Fed is always wrong? And he was kind of taken aback by that. I didn't mean it directed at him, but really, you look at the Fed, and forever and ever, I mean, it's like a forever war against growth. There's 1.7%. That's the Fed number for the long-run growth rate of the economy, which I think is a failure.
I think that's not
the growth of this economy with good policies and productivity like we have now should be at least in the 3s, which is what it was for 100 years, if not 4s. Now, why is it that the Fed is always stuck at 1.7?
Well, I think if you look back, and I've been very consistent in my estimations of how much I think we'll have growth from year to year, and mine's always in the mid to high 2s. So I think I view things a little bit differently.
I mean, I watched my friend Jay Powell, whom I've known a long time, had lunch with him every month when I was at the NEC. But he's obsessing about tariff and inflation all of last year, and along with the rest of the economics profession and along with the board staff. Trouble is, there's really virtually no evidence of tariff inflation, at least for goods, right?
I think
you would
that's
agree with
borne
that?
out absolutely over the last year.
But they don't. I don't see him getting up at the podium for these press conferences and talking about the importance of lower marginal tax rates, 100% depreciation, drill, baby, drill, deregulation across the economy. In other words, pro-growth economic policy. Why doesn't he mention that? Why doesn't the board staff mention that? Why don't more of the governors talk about that? I mean, if you had a movie of what they all said last year, the obsession with tariffs and inflation, which never panned out, that obsession was incredible. I mean, it was like they all need to go to a rehabilitation center.
Well, I think it's important, as you know, and as you've said many times, it's important that we focus on the benefits of supply-side policies.
Yes.
They increase the productive capacity of the U.S. economy and productivity itself. And things like lower taxes, you know, better, more friendly business and consumer laws and deregulation, as you mentioned earlier, are an important part of that. And I think we're starting to see the benefits, or we've been seeing the benefits with strong growth over the last year.
Well, I'd like to see some of these FOMC members talk about it too. I mean, it just blows me away. They go after the stuff that doesn't turn out right, and they don't talk about the stuff that does. It's a very strange thing. Anyway, Mickey Bowman, modernizing the Fed. We appreciate it very much.